This episode is sponsored by Property Filter. Find great deals faster.
Hello and welcome to the Financial Freedom Podcast, sponsored by us at Property Portfolio Building. This podcast is designed by real people on their journey to achieving financial freedom, and we'll focus on people who've either already attained it, who are joining us on that journey, or maybe a specialist topic that can help you build your technical knowledge to achieving and maintaining that financial freedom. We hope you enjoy it.
Right, welcome back to the Financial Freedom Podcast. Today, we've got one of our technical topics, but we are talking all about choosing your property strategy. There's a huge abundance of strategies out there that you can implement for your property journey. And today, we're going to go through the do's, don'ts, and the possibilities out there and try and simplify it for all you budding investors out there. So as always, I've got my co-host and business partner, Phil, with us. Welcome to the show.
Hi, Tim.
Great to have you. So just to kick it off then, how do I choose my property strategy?
Yeah,
How do I go about it?
It's the hardest thing, isn't it? Yeah, if we're open and honest, you know, people who are on educational courses, people that are training, people that are just starting out, it's the hardest thing, and it's the most common mistake that people made. Certainly the mistake I made, probably the mistake you made. And if you're uneducated in property and you don't understand where you are, you're probably going to follow a similar thing, which is, I've got some money, I'm going to buy a buy-to-let.
Yeah.
Right? That's what everybody does. That's not necessarily a
Or the other one you think of, I need to do like a flip to like buy a property, make some profit, sell it and build up a capital pot to then buy buy-to-lets or something like that. That's the typical scenario, I'd say.
Yeah, absolutely. So the question is, how do I choose my property strategy? There's actually some layers to this question that you can look at, sit down and have a think about before you even decide where I'm going to apply my time and funds or whatever. So the first thing is always, where am I on my investment journey or my assets journey or my income journey or my financial freedom journey, as we call it, right? So, and how
do you know where you are then from that?
Good question. So where am I? So where am I on my financial freedom journey is a really simple thing that you can look at, right? So there's something called the wealth hierarchy that we talk about in property circles, and it starts with 3 layers. It's cash flow, profit, and assets, right? So you can apply those things to your daily life. So imagine that's similar to how businesses work, right? Yep. Cash flow, profit, and assets, similar to how business work. You can apply it to your life. So the normal thing from a cash flow perspective is people have a job. Yeah. That is or income that they earn, right? That is the normal
So we're
thing.
saying level 1 cash flow for investing or property is the equivalent or same for someone that's earning a salary or whatever in a job. Yeah.
Then you got the level 2, which is profit. Now that can be sometimes in the it could be bonuses, it could be inheritance, it could be any of those things. And then level 3 is assets, and assets are things that you are owned. So in a company, it could be the place that you are, it could be the stock that you hold, it could be any of those things. In life, it could be pensions, it could be investments, it could be property that you hold, right? So if we talk about cash flow, profit, and assets, it's just starting by analyzing, first and foremost, where you are in your life. Am I 100% reliant on cash flow? Do I get profit? Have I got any assets? You start there, and then that will help you to understand where you are, because depending on where you are will depend on which is the best strategy for you ultimately,
and what you want to achieve.
Yeah. So the first thing is understanding where you are. The second thing is that what is your objective?
Yeah.
Right. What do you actually want to achieve? So if my objective is similar to mine, which is I've done 20 years in a sales job and I don't want to do it anymore. I won't lie. I was managing director of an organization. Don't want to do that anymore.
Yeah.
So my objective was I need to target my cash flow because I no longer want to have that salary. So I want to target the cash flow the strategies that I need to deploy will be cash flow strategies to replace my income. Now, don't get me wrong, in property, generally, we're looking at cash flow or money income from all investment strategies from property, but there are higher cash flow strategies in property for certain types of property and vehicles than there would be if you talked about it as a longer term, medium return asset, as an example.
Yeah.
So, and the way that I would look at that is we, and I say we, but me specifically, I own assets in all of those fields because I have, but the cash flow assets that I've chosen is, and I chose two. One didn't go very well, which is rent to rent, and the other one is HMOs.
Yeah.
Okay. So, and they are my level one. So that was to replace my, to pay for my life, so my cash flow assets. So depending on what you want to do, or depending on your objective, if you love your job and you say to yourself, I've got 10 years left, and you are making more money in your job than you spend, then you're already making profit.
Yeah.
So you may not need to do cash flow assets. As an example, you may want to just look at increasing your profit level, or putting your profit up to the asset level, which might be things like long-term commercial assets. It might be S&P 500. It might be single let properties or whatever, right?
Precious metals, gold, silver,
exactly.
etc.
All of those things can sit in your. It doesn't have to be just necessarily be property, but it comes down to your objective. Normally we're talking to somebody who says, right, I don't think in 10 years I'll be doing the job.
Yeah.
So I need to replace my income now, and that again is normally a failure because people look at the gross income. So I need to replace my gross income. So if I'm on 120 grand a year, I need to earn 10 grand a month. Do you? Is the other question, or do you need to pay for your life from that? And that's again is how to choose your strategy, and you should be doing this regularly, because choosing your strategy regularly is because you don't just want to follow one strategy and then keep doing that, because what if you're no longer on that strategy level?
But then cover your expenses can vary, can't it? Because
Yeah.
the scenario you said there, where your salary is, say, gross £10,000 a month,
Yeah.
and you spend 10,000, it's the same thing.
Yeah.
But then you're not living below your means at that point, are you? But also on the flip side, you could be earning 10 grand a month gross, but you could be living off, say, 5 grand a month, and you've got that 5 grand surplus. So what you're saying is, look at the first step and go 5 grand. If you know that that's your living expenses, cover that first.
Yeah.
Then you don't necessarily have to keep working that job. Correct. You've got your living expenses.
And I've picked a big number there. You might be on 25 grand a year.
Yeah.
It doesn't matter. It comes down to, well, how much does it cost to run your life as it is?
Yeah.
In your must-haves, your mandatory spend. How much, and if you're looking to replace your cash flow, your job cash flow, to pay for your life, then how much does your life cost? That would be the first thing that I would recommend that people do.
So on this then, so my next real question is, if I want to achieve, say, £5,000 of net cash flow.
Well, just before we get into that,
Yeah.
because that's a good question to follow up to this one, I would actually say before we do anything else, is once you understand actually which level you're on. So if I'm going to replace my salary and I need to do it, within 3 to 5 years, then you're going to do some cash flow strategies, okay? Yeah. And cash flow strategies can be things like rent to rents, it can be things like HMOs, it can be things like service accommodations, it can be any of those things, it can be multi-income blocks, it can be multi-commercial blocks, it can be all of those things, but it's basically you're trying to earn more generally from the same amount of spend as you would from like a single let asset or something. So the way that I would say it is like, if you think about the cake shop analogy, it's like if you buy a cake, the cake costs you £10, let's say, to buy the cake. If it's an asset, if you're going to keep that cake as just for yourself, then it's cost you £10. But if you want to sell that cake onward, you can slice it up, right? So you can put it into slices and sell the slices, and that's how then somebody who sells a cake at wholesale to somebody who sells a cake in a shop makes their money. They slice the cake up and they'll sell it for pieces. So the pieces there might be 20 pieces. You sell the pieces for £1, right? So then cost you 10, sold for 20. That's the general concept. And your cash flow strategy is the same. So like a HMO cash flow strategy, in effect, is taking a property and splitting it into rooms.
Yeah.
So it's one property split into numerous income streams. So it could be 4, 5, 6, 10, whatever, however many rooms you decide on that. Service accommodation is the same, but it's normally nightly.
Per night.
Yeah. So rather than it be rooms, it might be rooms, but it's normally per night. So you're splitting it up per night, and that's why some of the other strategies you can then implement. Because if you don't want to own it because let's say funds is your issue, then you're going to talk a little bit more about, well, I might rent something, and then use one of those other strategies. So I'm going to rent the cake, and then I'm going to sell off the pieces. So that's how some of the good rent to rent strategies work. So if you're going to do those types of things,
so really what you're saying is the high cash flowing type scenarios of that commercial basis where you can split things up into numerous income streams.
Yeah. And before we even talk about the next part, at that point, it's a case of you've made your decision, right? You understand where you are on the hierarchy. So I know I need to leave my job, or I'm going to keep my job. And, I've got enough income. I don't need to do the cash flow strategy. So I'm going to look at profit strategies because profit strategies will increase my overall capital availability. And then I'm going to do something then to buy assets with the profit. Because the normal thing that somebody would do is they often skip the middle barrier, the middle ground as well, the profit strategies, because they get some extra cash flow and then they put it all into one asset. And that is a common mistake. But the problem with doing that is once you've bought the asset, the capital is stuck. So if you've got profit, then there are other profit strategies you can do, such as buying and selling or flips or other, loans or whatever, that you can make money on your profit. Then you can invest in the assets. So the middle barrier of that profit area is increase the profit to buy assets from that.
So the classic mistake that I made personally when I started investing in property in the UK was my first 4 properties were buy-to-lets, which we're saying is the top of this asset class, because they're long-term, solid wealth-building assets that you could keep until you die. But it may not get you the cash flow as quick as the scenario you're talking about by splitting up into pieces.
It's unlikely they're going to retire you, isn't it? No. Ultimately, you're making 200 quid a month.
And then I tied up all my funds I had available at that point, and I was stuck. And that's when I went, what do I do now? Because really, I do want to build up some cash flow to leave my day job to get more flexibility. And that's when I looked at other strategies, which hence, like you're saying, if I started with those higher cash flowing activities, I could have got to a cash flow goal through, say, property quicker.
But the key thing is even if you do the cash flow strategies and the cash flow goals and you hit where you need to be, it's then don't do the same mistake. Don't just jump to the asset. Because if you've got your job and you jump to that asset, then all your money's stuck in that asset, and then you've got to wait for the job to generate enough money. That middle profit area of how can I increase that area? How can I use the money I have to make more profit, and then potentially use I don't want to say profit on profit, because but the extra capital that I've generated to then buy an asset and protect that money in the middle. There's strategies around how I can do that, because if you can continually buy assets because you're continually making profit, then that's going to speed you up much more than anything else. So if your job is they're going to continue and you've got money, then you might want to consider flips. You might want to consider doing some trading, or you might want to consider doing some loaning or some of those types of things to generate more money on your money, and then use that additional profit to buy assets. That's a good way to increase that asset base faster, if you like. And at that point, then you're ready to think about your strategy. We've not talked about exactly what that might be yet, because at that point you need to then look at what are you missing. So, and it's going to be one of 3 things, right? You're either missing education, you're either missing time.
So education, say, and knowledge.
Well, education and knowledge I'll put in the same bracket just for this purpose. Education and knowledge in the strategy that you are going to be adopting is certainly for the next couple of years, because it's not short term.
Or expertise.
Well, education, knowledge, and expertise is, we're going to put that as one point.
One area,
Time or funds. Right. So they're 3 clear areas. So it's just being honest with ourselves, really, or honest with yourself to say, okay, I now know I want to replace my job, and I want to be able to pay for my life because I don't want to do the job. If you want to replace your income, but you don't have to do it for 10 years, then you don't have to, you can do the assets. You do the profit in the assets. You don't have to worry about the cash flow strategies, right? But if you want to replace the job in the next 2 to 3 years, then you've got to do something in the cash flow asset strategies. So that's the kind of thing is that, well, what am I missing? So when I made that decision, then I need to know where I am. So it's education or knowledge and expertise, which is the same as knowledge and expertise, really, because you won't necessarily have the experience. Okay. So it's time and it's funds. And then you need to decide on how am I going to get the right strategy with the right element of experience, time, and funds. So if your problem is education, time, and funds, I would start with education. If your problem is education and time, then I would start with education. But if you've got funds, I would probably look to, say, partner somebody like a lot of our clients are those people. They don't have time. They've been educated in maybe HMOs, which is one of our most popular products. And therefore they come to us to do the expertise-based thing. Whereas if you've got the expertise, say you're a builder and you don't have the funds, but you have the time, and then you might need to just partner somebody who has funds. So it's about really just analyzing what is it I'm missing at that point from that part. So the first point of how to get to your strategy is actually don't choose your strategy, understand where you are, understand what your objective is, and understand what you are missing, and then really look at your strategy itself. And now we can talk about the actual strategies. And that fundamental first bit is why people get it wrong, in my opinion, and why I got it wrong. So if I can help with that in any way. Then.
So if you look at, okay, we've gone through all that, where you are, where you sit on those 3 sectors you mentioned. Then you want to start building up, a plan and a strategy and a goal, say. So if I put some scenarios out there,
let's do it.
If you want to, tell me where you think you go from there. So let's say we want to achieve that £5,000 of net cash flow per month.
Right.
Within, say, 2 years. I've got £50,000 of my own money.
Yep.
What would you consider, or what would you need to do to build up, a plan for strategy?
So I'm looking at cash flow.
Yeah.
So where am I? I'm looking to replace my cash flow strategy, my cash flow within 2 years, 2 to 3 years.
Yeah.
So I'm probably leaving my job. Let's say I don't want to do the job thing, or there's something going to happen. Or
so let's say in 2 years you got a target to be able to leave your job. Yeah.
So my objective is to do that. So I'm on cash flow assets.
Yeah.
I'm leaving my job, and then what am I missing? Okay. So I have some funds, and I have my time. I'm working.
Yeah.
So I'm going to have restricted time, and I'm just starting out. So I'm going to be restricted on education. Okay.
So let's say a certain amount of time to dedicate to it, but like you said, not full time, maybe part time, 10 or 15 hours a week or something like that.
Yeah. So the first thing I would do is look at where it is out of those 2 things and say, right, I want to therefore become an expert in one of those things. So if I've got £50,000, I have some funds. Now, if £50,000 is enough to do something, but it's not enough to do everything. So you can do something, but not everything. I would look at education.
Yeah.
First and foremost, I would look at doing something. You don't have to go down. We went down obviously the full year course, mastermind. It's a big spend and so on and so forth. And obviously it's paid us back in dividends. But you can do that, or you can do something which is a bit more specialist. So if I've already said, right, actually I know what I'm going to do. Because I knew nothing, right? So I know what I'm going to do. I'm going to do, let's say, a HMO. Then I'm going to go and surround myself with HMO people. I'm going to find out, I'm going to educate myself, probably do some training, understand what HMOs are, look at the regulatory environment and all those types of things, and then make a decision as to how I'm going to move forwards, and then build a budget. So I'm going to say, right, based on the funds that I will have remaining, how am I going to do this HMO? So and the HMO industry is like any industry as a whole. You can do, really high-end ones like we do, which, 50K is probably not enough. To do the first development. So therefore,
no, because we stack a deal as a 5-bed conversion, you need probably a minimum of £100,000.
Yeah, exactly. But that's for an all-on suite, professional standard development. Yes. Whereas you can get 4 and 5 bed HMOs, which are 200 grand.
Yeah.
So you might have enough.
You could do a lower end of the market.
You could do a lot, or you could do one on a social lease or whatever, or you could joint venture and you could find somebody else who's on the same journey as you, and the place that you're probably going to find that person is in the same place you're probably going to do the education.
Yeah.
Right. You're probably going to find, because you're networking with people who are committed in the same way, and wanting to do the same or similar things. And you can probably, that's how we met, certainly, and how we did our joint ventures. All our joint venture partners have come from the same environment, the educational and training and knowledge environment. So I would start there.
So in that room, as an example, even where we met, there's people in that room that have quite a bit of time or a lot of free time, others that have almost no time,
no
very,
time.
very busy,
Yeah.
some that have a decent pool of funds,
Yeah.
others that literally have none, and
Yeah.
they've maxed out just getting into that environment.
Yeah.
So, you know, obviously by talking and networking, you can find these people, can't you?
Yeah, and then it's a case of them breaking it down into chunks. Okay, so what am I trying to achieve in 2 years? £5,000 net cash flow. So, or cash flow, let's say.
Yeah.
So what I then need to know is how am I going to do that? So if let's say the traditional thing you hear in education is, or in the networks is, your traditional HMO, you're looking for about £1,000 a month cash flow. Okay, so that would mean you
Cash flow profit is a good way to describe it.
Yeah.
After costs,
after bills and you know, mortgage costs and so on and so forth. So what do I need? Well, I need 5 of those to hit that number. Okay, so within a 2 to 3 year timeline. So if I need 5 of those, then you can work out. You can go back to the drawing board. What am I missing? Okay, so if I know I need, you know, £500,000 to do 5 professional HMOs using bridging and development finance and all that type of stuff, then I know I'm missing £450,000.
Yeah.
So then I can go back to the drawing board to try and find the partnerships and the private investors and the private funding to work with those. Or I can do joint ventures where I'd use my time, some of my money maybe, to get deals over the line. You can, if you've been educated, you might be able to do some of the more fancier contracts. Like you might find a good commercial to residential deal where you could do an exchange or delayed completion.
Yeah.
Then find the funding partner who might want to JV that with you. You know, there's all those types of things that you can do with that pot. Or you might want to set up the little rent to rent business, which is actually, I don't need to own the property for a rent to rent business, which if you do it properly, not the way that I did it, if you do it properly and you are in full control of it, then you're going to rent a property and then use it for something that is going to be generally a cash flow strategy. So I'm going to rent a big, you know, 4-bed, 2 reception room, Victorian property, terrace property, and it's in a non-Article 4 area, which I've learned on my educational journey. And then I'm going to rent that for £1,500 a month, and I'm going to rent each room out at, you know, £800 a month or whatever, and I'm going to make the profit in the middle. And I need to do that. You probably need to do 6 of those or 7 of those, because you have to pay a little bit of a higher premium to the person who's renting it to you in the first place. So you might set that up, and you might set that up on a JV basis. You know, you might have other people that you do it together with, and that kind of thing. Or if you just, because if you're trying to replace 5K in that timeline, you're effectively, what you're saying is, I'm going to replace my job.
Yeah.
That's what you're going to do with property. But to be honest, at the cash flow strategy area, with the 50K, you probably are going to use your time again.
Yeah.
You're going to have to use your time again, because you're going to have to either be networking consistently to find the JV partners, offering deals on and doing after viewings to do like exchanges, like completions, or running a rent to rent business. And normally a rent to rent business wouldn't have an agent involved necessarily, a managing agent. It would be self-run.
Yeah.
Because there's not as much margin to then be able to say, right, here's a managing agent who's going to run my rent.
So it's a good point there. So with this level 1 cash flow, you can have rent to rent strategy, which is not owned property or asset backed.
Yeah.
To me, that is more time and energy involved than another cash flow strategy, which we deal a lot in, which is owning a HMO. Where, like you said, you can have a managing agent.
Yeah, you're pointing a managing agent.
You can add more systems, processes to make it less noisy.
Yeah.
You know,
And the reason for that is because if you're going to rent something and that person's paying their mortgage, they're going to want a profit on top of that.
Yeah.
Right. So that normally is the bit that you'd normally pay to the managing agent.
You're trading more of your time
Yeah.
for that expense. In essence. Yeah.
But with 50K, it's not undoable.
Yeah.
You know, because you could do 5-6 rent-to-rent deals with that funds. But I would start with the education, definitely, if you're going to go down the rent-to-rent. There's some really good rent-to-rent business building products out there that are available. That the people who are actually doing it, who will help you with that, and you can just join them. You know, but it comes down to, again, where are you on the journey? What are you missing, and what's your objective? And you just answer those questions. And so we're at 50K, so I'm missing a bit of funding to do everything I want to do. To get to 5Ks, you're going to have to do something which replaces a bit of time, or JV, or find funding partners, and that's what you would have to do with that.
Another key thing to talk about there that you've mentioned is obviously joint ventures, because if you want to get £5,000 a month, if you're doing it on your own, let's say £1,000 for 5 properties.
Yeah.
If you're joint venturing, it's either 10 of, if you're
10 of
splitting
them,
it 50-50, say,
yeah.
it's either 10 of that property or 5 of sort of double the income stream in a way.
So let's say your traditional 5-bed all-en-suite property might cost you £100,000, let's say, in as well as bridging and development finance. Then a 10-bed, just for the quantum of ease, let's say it's 200, probably isn't just as much, that's probably a bit less, but let's say it's 200, then you would need to find somebody to JV with those funds, and then you would do it on a 50-50 basis, you know, so, but the same output, the same income, if you know what I mean. So, and a project, it's a project to do 10 versus 5 is obviously more complicated, but in practice, it's not too much dissimilar in time. You know, it's better to sometimes think about it in those.
Especially if you can replicate the process and the system and the teams and all those sort of things.
And then again, if you're doing it over 2 years, then it's, if you think it takes 4 or 5 months to do a development, then you need to be starting one development every 4 to 5 months.
So I think there's 2 common mistakes I see with when we're talking about joint ventures. Some people are very reluctant to get into it because they're like, oh, I'm giving up half of the share of the property, which you know, what's better, 0 or 50%? So you got to consider that. So that's one mistake I see is people like they're not really getting off the ground because they don't want a joint venture. Whereas actually, if that gets them going and they can share the profits, then why not? And then on the flip side, you've got people who jump into a joint ventureship too quick and give too much away when they shouldn't. So
well, I guess it comes down to the question. It goes back to where are you and what is my objective again. So if I am on cash flow, if I'm on level 1 cash flow strategies, and I've got 50k to spend there, and I want to replace that cash flow, then almost the best way to do it would be to find funding partners into that. Because your objective is to replace your cash flow. At this point, your objective isn't your long-term generational assets. That's objective 3. You know, so if what you're trying to do, your objective is get out of the day-to-day job, then get out of the day-to-day job. You know, that's what your objective is. And if you can do that quicker and faster by having a good finance partner who's just interested in getting a return on their money, or somebody on a joint venture basis who wants to put money in for a 50% return, even if you then only hold those assets for a period of 10 years, and then you sell them for profit in the future, well, then you've leveled up. You've gone from level 1 cash flow assets to level 2 profit, and maybe that profit then you could put into a.
And then the caveat to that is that you have to be very careful of the people you joint venture with, because you know things can go really well and things can go really wrong, can't they? So we talk about it. It's always understanding how well you can work together. Because if you're going to keep property even for 10 years, you've got a 10-year relationship there minimum. And you know, if things were to go wrong, you know, what is the plan in those circumstances, and really understanding that partner, because it can go well, but it can go.
Well, I mean, you'd want shareholders agreements and how things would operate, and make sure you do things properly. But I mean, it comes to, again, though, we're going back to what is my strategy? Well, where are you and what is your objective? That determines your strategy, and then it's what you're missing. So, and that's the thing that people don't get. It's the thing that stops people from moving forwards. If you decide that actually the job thing is okay, and I've got 10 years and I've got 50k in the bank today, then you're probably not on the cash flow strategy. You're probably on the profit strategy. You want to use that 50k to build more profit, and that could be flips. It could be loaning something to somebody. You could be the private investor, somebody who's on cash flow strategy, as an example. You know, you could get a return on that investment. You know, or whatever. I'm not saying do that, and you know, please, you know, do your own due diligence on everything that you do. But if you're longer term, so well, actually, I don't need to have that replaced for 10 years, then I'd be protecting that. I'd be looking to build that profit and use my additional profit for those asset purchases. I'm looking for good creative strategies to maybe control property, maybe look at purchase options to start to control property. Again, I'd still be looking at an educational thing for that. But if you're not looking to get out of your job in the short term, chances are joint ventures are not what you need in the shorter term. You know, you probably don't need to do that. If you're looking at it from I only want long-term generational assets to pass down to my family, then that's your focus. You know, focus on how I
do think as well, sometimes it really depends on, like, say, where you're at in your life, like age, you know, if you've like, let's say you're a retiring doctor or something, and you don't need high amounts of cash flow at level 1 and you just want to get long-term assets to pass down to your family or to get a return and to build wealth, then you don't have to necessarily go to the level 1. You can go straight to that top assets because of where you are in your life. And
I mean, if you have capital, then that's different, isn't it?
Stop the podcast now. This episode is sponsored by Property Filter. Property Filter is the #1 property tool for today's property professional. It brings in all the data points and sources from all the property portals and auction sites into one convenient place. Then you have the option to overlay all the clever strategies found in the Property Filter blueprint to find motivated sellers faster. Now, we use it on a daily basis. It saves us over 80% of our time when looking for properties. And if that sounds like something that you want in your lives, please go to register.property-filter.co.uk/PPB, which is the discount code for this podcast. You will get 2 weeks free and a discount on your first month. That's it from me. Back to the podcast.
So do you have any more scenarios?
Yeah. So the other scenario I would say is almost flipping it the other way and going, right, let's say I've got £400,000 or £500,000 or something like that. And I want to get to a similar cash flow goal from property in 4 or 5 years. How would you differ your approach? What might you do differently?
So again, £400,000 to £500,000. It again comes down to the 3 questions: where am I? And what is my objective? And what am I missing? So I'm still going to answer those questions. So where am I? So if it's I'm looking to do it over a 5-year timeline, then that's probably different even now than if I was looking to do it over a 1 to 2 year timeline. So if I'm looking to replace my cash flow goal, or to pay my mandatory costs in my life from that 4 to 500, I'm probably going to divvy that up into pots of 100-ish K at a time, and I'm probably going to still buy cash flow assets, because I don't want that to chip away if I have to stop working for any reason. I want the cash flow to be maintained. So I'm probably going to do either go down the service accommodation route, or I'm going to go down the HMO route. I'm going to do maybe commercial property or something like that, something that's got a high yield. That's what we're looking for really, is a high yielding, good cash flow property strategy. So I'm getting more money per square foot of property as cash flow than I would be on a longer term yield basis. Especially if you're trying to get to £5,000 over a 2 year timeline. I'm looking to do it at a 5-year timeline. I might still do HMOs, but I don't think I would do it as aggressively as I would do. I don't think I would use bridging and development finance. Number 1,
or use a lot less.
So if I'm doing 4 projects in a year and a half to get to that 2 year goal, then I'm going to have to use bridging and development finance. And that is pricey. And challenging.
Or you might have to raise extra separate finance from a private investor or something. Exactly, because you're going to split it into pots. So I'm going to put my own deposit in of 100 grand. My project is 300 grand. I need to find 200 grand. It could be bridging and development finance, or it could be private investment. It doesn't. Either of those. I'm probably going to slow things down, and I'm probably going to use my own capital to protect my capital. Because if you think about it, if I'm borrowing, bridging and development finance is quite expensive. It actually works out anywhere between 15 and 18% of the total borrow. So for every 100 grand I borrow, I'm borrowing between 15 and 18,000 pounds. When you account for all the fees, solicitor fees, drawdown fees. So let's say the actual rate you get is 1% a month.
Forget
which
that.
People think that's 12, but you're saying, you add on all of those other fees and costs, it actually ends up being 15 to 18%, doesn't it?
Yeah, absolutely. So if I do 4 projects and I've borrowed 200 grand a project, so each £100,000 is carrying between 15 and 18,000 pounds. So it's basically 30 times 4 I've spent just on finance, which is effectively 120,000 pounds, whatever it is. So I've lost that of my original capital. It's gone. You might be able to make some of it up in the development uplift that you get on your project, but ultimately you've spent that on finance. Whereas if I don't need to do it and I'm looking at a more 5-year timeline, I could do 1 project a year. And I could protect that. And you might not recycle all your money, but I'm going to be a cash buyer. I'm going to be able to move faster. I'm going to be able to be more negotiating at the front end because I'm not beholden to bridging loans. I don't have to worry about valuation, surveyors, and things like that.
So you're saying 500 grand, 5 years, you want to add £5,000, you just do one of those £1,000 a month cash flow projects a year and limit the money that you tie into the deal from other finance.
Yeah, I mean, you might
do it
even be able
a bit
to
slower because you now got 5 years instead.
Yeah,
of 2
so let's say you did it over 5 years and you self-funded project one.
Yeah,
and you left in some money.
Yeah.
But let's say if you use bridging and development finance, you're going to leave and you put £120,000 in as an example. You might leave in 50 to 60k. If you take 30 to 35,000 pounds off that, you're going to leave in anywhere between 25 and 30k, right? As a typical example. Yeah. Now you might make 25k over 2 years in your let's say it's a HMO in your HMO. So you're going to replace that finance within 2 years. You're on a 50% return on investment if you financed it yourself. So if you're doing that, by the time you're on project, by the time you're in year 3, all money's back out from projects in year 1, right? So you've replaced that money that you've left in equity. So over a 5-year timeline, you can probably do the number of projects you need to do before you're on project 4 or even project 5 before you need to worry about using finance, a heavy finance, to get to that next level or whatever. I mean that's a much different,
a bit slower, but you get to the end result.
But absolutely. But it's just being realistic, because if you are adamant, no, I need to get out, then don't worry about the bridging cost, because the cost is another 3 years of your life. That is invaluable.
The faster you want to do it and the more projects you want to do, the more you really have to leverage or raise private investor finance, don't you? Which is where I found myself a few years ago.
Yeah, well, you did a crazy number of projects in 2 years, right? Because you wanted to spend the early parts of your kids' lives together with them, right? You didn't want to be traveling around the country and doing big developments for other people.
Yeah, absolutely.
So how many did you do in 2 years?
Well, in 2 years, I probably did about 15-ish projects or thereabouts.
I mean, I wouldn't recommend that to anybody. I wouldn't recommend that.
Yeah, but you very challenging, very difficult, especially balancing the work and doing that. Even with a lot of my project manager expertise, it was challenging.
Yeah, but I mean, you can do it, and you'll have leveraged up pretty much all of those, right?
Yes, they know. Well, almost all of them were using bridging development finance, bar 1 or 2 with cash.
So 10 times 30, that's how much. And then at 50% again, that's how much you spent. The finances should have been inviting you to the Christmas party, right? So,
lots of finance. But
again,
because they were good deals, and I was using a lot of my experience in a decent amount of time, it's still stacked up.
But let's look at it then. So where were you? You were on your cash flow goal and you wanted to replace your salary. Your objective was to replace your salary in 2 years. What were you missing was education and funds and a bit of time as well. You're probably missing all 3, to be fair. And so what did you do? Is you got education first. You then used your time and expertise.
That's why I said knowledge and experience, because in that bracket, I had a decent amount of knowledge and experience in a aspect of property investment, development, however you put it. But then I needed further education in other facets. So sometimes there's a gap in education or
So you partnered, JV'd, and did all of those things to get those projects over the line.
Yeah, absolutely.
So that's what you can achieve, right? If you do it right. But you started with education. Yeah, which is the one that I would always recommend people start with. But it's a good example.
Yeah, once I got stuck and I was doing those level 1 assets and I ran out of money, that's when I thought I really need to learn more.
And now you get to spend more time. You get, like you said earlier today, you have breakfast every day with Seb, and you do Rice Krispies every day, and and you get to do these things, right? Which is lovely. Whereas before you might have been in a project in London and not been able to do that. But the important thing for you was using the leverage at the time. So if you'd have had that time again and you had 500 grand and you didn't yet have the time with the children, you'd have probably slowed it down and done it a bit more.
Would have been a different approach for sure.
So that's how I would approach that one.
And then so another example or a scenario I'll put on you is, like, let's say you want to get to that £5,000 goal. Maybe you're a bit younger, just out of uni, you don't have any real funds, you've got a student loan or something like that. You might be working part-time and you've got a decent amount of spare time. How do you get to that goal? What should you look at that
Just
point?
become really good at doing deals.
The
opportunity there for you is massive.
And you're young as well, so maybe you can take a bit more of a more energy, more risk taking potentially. Obviously, get educated as well.
I'd still start with education, but I mean, if you've no money,
Right. So there's a good example. So our mastermind course, whatever it was, say 20 grand,
Yeah.
you know, at that age, you don't have that money.
Yeah.
So it's hard to do that course, but obviously there's other education you can do, isn't there?
Is it hard? Is it hard to do that? So there's
Well, I'm asking you.
Well, there's a girl who did the course, who was basically funded by family and friends, and she promised to pay them a return.
Yeah, yeah.
So it's about what is the objective and what are you missing?
Yeah, so it doesn't have to be your money.
Yeah, it doesn't have to be your money. Yeah. No, absolutely. If you could say, oh well, I'll give you from the projects that I do in the future or whatever.
Yeah.
You know, I'll give you a return or whatever. You could do that. I would look at you, but I would look to surround myself with people who are doing it.
Yeah,
and doing it really, really well.
Yeah.
Because if you're
you can go to networking events where, let's say, it's £25 entry fee or whatever, like ours, and there are people that are doing it there that you can learn from and network with.
I mean, there's a good example actually, because I'm meeting a chap next week for coffee. Yeah. Right. So we do this full time. He's starting out. He's a young man. He's not paid for the course, but he's turned up.
Yeah. He's
turned up to the networking events. He's asking questions. He's asking the right questions. He's doing the wrong things, but he's asking the right questions. So I've said, listen, let's set some goals. Let's sit down and set some goals, because what you'll find is when you work with people and when you network with people who are doing it, it's actually a really helpful environment. So to give somebody that time, I mean, I'm not going to give everyone. You don't give everybody that time.
Yeah.
You know, we get asked questions all the time, which is,
but you definitely
can I have some of your time? Yeah, we'll turn up to the networking.
But you definitely like to see people wanting the time, don't you?
Yeah.
Because you really see like, oh yeah, this person's really doing something, and it really disappointed me last week because I did a talk and you know, I talked about my cash flow and what I've achieved, and I said, who wants to achieve this? Everyone put their hand up, and I said, all right, great, come and talk to me in the break. Did you come and talk to me? No, hardly anyone.
It's
like, why not a consumer? Maybe people, I don't know why they didn't, but maybe I'm not that approachable or whatever.
Yeah, I'll take that, mate. Yeah, absolutely. 100% no.
But, you know, I look at that in reflection and like, someone said that to me, like with what I know now, I'd steamroll.
And the ironic thing,
if that was me 10 years ago or whatever.
The ironic thing about that as well is that you've already asked them to do it.
Yeah.
You've told them what you've done. They've already made the effort.
Yeah.
To attend the event.
They're at the event.
And they haven't come to talk to you, which is, you know, something, isn't it?
Yeah.
But I mean, that's the thing, is to surround yourself with the right people. So, I mean, I was still playing rugby and drinking every weekend and all that kind of stuff. And there's nothing wrong with that.
Yeah.
But it just meant that I started later, you know. Yeah. But if there are people listening that would do it and wanted looking to start earlier, then I would say that if you surround yourself with 5 successful property investors and you try and spend more and more time with those people, then you will become the sixth successful property investor.
So if I'm this young person then, and I don't have the funds, I'm going to networking events and all these sort of things talking about, and I want to raise money for property. Should I be looking at like, you know, trying to do like flips for profit to then raise the money, or how do you think I should approach it? That's
the typical one, isn't it? That's the typical thing that somebody says to you is, oh, I'm going to do a property flip. But they're hard, right? You know, property flipping is really hard because there's so many factors that are not in your control. And the number one of those is the sales price at the end.
Yeah.
You're totally reliant on...
A little bit market dependent because
market dependent.
There can be volatility in the market.
Conveyancing dependent.
Yeah.
Mortgage provision.
Buyer
availability.
Yeah.
Finance availability if it's a mortgageable product. So is it the best thing to do? I'm not sure, but there's lots of...
Because it can go well, but it can go wrong as well, especially if you're doing a refurbishment. And
yeah, so you've got 18 years experience. I know a project that you didn't do very well.
Yeah.
Right? And it's not that you didn't do it very well. It's that you set off with all the right aims and time killed your deal.
Yeah.
Right? And that's it.
Yeah, and that risk is involved for anything. Yeah, so like, you know, I did, a couple of flips at the same time. One went well.
Yep.
The other one, seemingly at the start, was a better deal, but because the buyer for one of them wasn't as good and wasn't as reliable, was slower, etc., the time killed the profit. But the other one completed quicker. So it's a little bit of an unknown. So with the flip, might be done and dusted in a few months. It might be 12, 18 months. Yeah. It's very unreliable when the timing of when that's going to come in.
Yeah.
And if that's the case, and you become really motivated yourself to sell, you might actually end up losing money. You've done all that work.
Yep.
Whereas if you're, say, teaming up with someone as a joint venture, they've got the funds straight away.
Yeah.
Then it's good to go.
But you might not even need to do those things, because if you educate yourself properly, if you're a younger person, or even it doesn't even need to be a younger person. I mean, there's things like the power of the lease option.
Yeah.
Right. If you take lease options or purchase options as something in your arsenal that you can agree, you can help people sell property. It doesn't cost you anything. You can do things like assisted sales.
Yeah.
If you understand what a distressed seller looks like, you could do assisted sales using an option over a property and help them sell that property. You can fix property problems.
Yeah, yeah. So you can raise capital.
Yeah.
To fund your deals with a bit lesser risk.
Yeah.
In a way, and maybe.
Yeah. So like an assisted sales strategy, an example. If I've got no money at all, but you need to get some legal advice, so you need some funds for that. But if you find a distressed seller who's really struggling to sell a property, and and you've spent your time educating yourself and surrounding yourself with the right people, and you don't know the answer to what the problem is, if you've got 5 people that you can call, by the end of that 5th phone call, you're probably going to have the answer, and then you can agree with the seller of the property.
Yeah.
I'm going to help you solve and sell this property.
Yeah.
We're going to work together for a period of time, and I'm going to solve the problem for you. And all you need to do is sign this piece of paper.
Yeah, yeah.
That's it. And then you can go and take a profit over whatever the agreed sales price is for the property.
So the other one I want to talk about then for this young property investor.
Yeah.
So a lot of people look at property sourcing, which the positive is that you learn how to do deals and sell them and all those sort of things. But I think one of the challenges is that because a lot of inexperienced people do it, and they maybe don't do it that well, it seems to fall down. So what would you recommend in that circumstance for it?
Yeah, I mean, it's like doing great deals is the skill.
Yeah.
And I think the thing that kills most people in that area is it didn't work the first time and they give up.
Yeah.
It's your first deal is never going to be your best deal. You don't yet understand what good looks like. I mean, we're still learning what good looks like, and we've been doing it for years. So
and there's always improvements that you do along the way to keep
100%. So and it's maintaining that momentum and continuing to educate yourself. So if you're going to do property sourcing, then it comes down to what deals you're going to do. So you need to surround yourself with the people who would be your buyer community. You're going to have to network. I mean, a lot of people we get letters through the post quite a lot, right? So because we are licensed properties, so we get a lot of letters.
Landlords. Yeah, I wouldn't say we get a lot. I get a few. Yeah. It's not like I'm flooded with them, because people think, everyone's getting letters all the time. They get a few, but generally when I get them, I open it.
So you probably don't get a lot of them now.
Oh, yeah, because they go
to the accountant. So I get them and I just ignore them. Yeah, sure.
But sometimes you get them, don't you? And you look up that company and it's generally like they've been on company's house for like 2 months or something. You're like,
it's brand new. Yeah, it's brand new. And we're not selling, right? So at the moment, so we're probably not the right buyer anyway. But so we're not selling our properties. But I mean, the thing about it is, it's being consistent with that.
Yeah.
And it's also using the right strategies to achieve your goal. I mean, some of the more complex strategies are things like lease options and so on and so forth. But it's only complex if you don't know what it is. Because if you can see a deal that strategy will suit, that deal will happen.
Yeah.
As long as you explain it in the right way. You're not going to turn up to somebody and say, I would like to do a lease option with you.
Yeah.
You're going to talk them through, find out their pain points, and then educate them in why you can solve this problem.
Yeah.
And that the lease option is just the mechanism to do that, as an example.
Yeah, it's a good point, actually, because like a lease option is a creative way of doing a deal, but it's not the strategy. Because I talk to people all the time, like, what's your strategy? Like,
it's not a strategy.
I do PLOs. I'm like, I'm very sorry to tell you, but that's not a strategy. It's a creative way of doing a deal or a strategy, but it has to be used in the right circumstance, doesn't it?
So, well, yeah, absolutely. And that comes down to, what is my strategy?
Yeah.
Right. So let's talk about that then. So what is a strategy? So a strategy is whatever you're going to deliver at the end that makes you money, right? So if you're doing HMOs as an example, like we do, our strategy is high-end working professional HMOs.
Yeah.
Okay.
It's the end product, and
that is the strategy.
Tenant,
Okay. So the end tenant. How we get there is tools. Right.
I don't know if I fully agree with that, because I think we do it in a way that's using a buy, refurbish, refinance model. to add value, recycle money, use momentum investing. And that the end product is the professional room with that professional tenant. You can also get ready-made. So I think having the ready-made compared to that is very different. So that's where it could differentiate in the strategy.
Yeah. So, but the end strategy is the same. It's just I might buy one that's ready to serve in that market.
Yeah.
Or I might develop one.
Yeah.
So it comes down to the question: where are we? If I had enough money to not have to do the refurb and refinance stuff, I could just buy them and then enjoy the cash flow.
Yeah.
Then that's different to me where we are, which is we use the BRRR method to momentum invest. So the strategy is momentum investing to do working professional HMOs. Right.
Yeah.
That's the strategy, isn't it? And that's what we do. So we buy, refurb, and refinance the properties to do that, and then we go one back from there. What types? So it's like, well, somebody comes up to me and says, well, I'm going to do commercial to residential. I'm like, well, actually, our strategy is momentum investing for working professional HMOs.
Yeah.
Commercial to residential is a tool, a type of project, a BRRR project that we will use to get there.
Yeah.
And one of the contracts we will use to secure the commercial property could either be an option agreement, it could be an exchange or delay completion agreement, or it could be a straight purchase agreement.
Yeah.
So those are tools to engage the type of development within the momentum investing strategy to achieve our end goal. So it's working backwards from that end goal. So as an example, deal sourcing. Okay, deal sourcing. What is a strategy? So my strategy is to make money from an investor that I've sold a deal to. Okay, so what do I need? Well, I need investors. What am I missing? Education maybe, or whatever. And you're working it back. So if the typical one is I'm a deal sourcer. And you hear it. They stand up at network meetings. They say I source deals for buy to let and BRRR and HMR. And I just go, no, you don't. You cannot possibly understand all of those. All of those markets. So if I want to be a deal sourcer, okay, if that's your strategy, what are you sourcing? So if you want to work with us, an example, and we know we're momentum investing investors, then you need to come to us with a deal that suits our momentum investing strategy for working professionals. So you'd still need to understand what our strategy is. And the way to do that is to network with us and to educate yourself in that strategy and then become that deal sourcer. So that is the fundamental difference between how you can actually implement something and not implement something as a strategy.
Yeah.
So our deal sourcing strategy in our business is no different than our momentum investing strategy for ourselves.
Yeah.
That's why it works so well, because we would do those deals.
Yeah.
So then
it's the same teams, the same processes.
Yeah.
The numbers work, the same areas, all these sort of things.
But there are some great companies out there. Our friend from Property Entrepreneur, Shiv, he does buy-to-lets that he would buy.
Yeah.
He sells them to investors from London because he knows that he would buy them, so they will buy them. And that's a much simpler strategy to the one that we do, because that's people who are not necessarily, he's targeting investors who are not necessarily on the cash flow strategy, they're on their asset strategy.
Yeah.
So it's a different investor mindset that there's, but he's attending different networking events. He'll go to the Baker Street one in London. We're not doing that. We're looking at people who want to invest in Greater Manchester for cash flow strategies. We're targeting different markets. So in terms of that as a strategy, because that's a typical one, when people get going, especially the younger generation, I don't have any money, but I'd like to become a deal sourcer. We see it all the time. I say, right, what? Really, really niche it down.
Yeah, and specialize and be the go-to person, and then knowing your pitch, isn't it? Because like you said, the people at the networking events we see, the pitch is too broad. They're not specializing anything. They're not the master specifically of one key.
Yeah, and it could be, what am I missing? Like you said, it's not just education, it's expertise.
Yeah.
So if I'm a deal sourcer, what am I missing is expertise. Well, if I'm going to be selling HMOs, then I might need architectural support. I might need broker support. I might need a power team. I might need builders who can do the work so they can price the jobs. I might need project managers I could recommend. All of these types of things. And you can build those teams up. But you're not going to be able to do that if you're doing HMOs, service accommodation, buy-to-lets. It's too wide. It's too broad.
Too broad.
You're not going to be able to do that. So it just comes down to making sure that you answer those three questions. And getting those like actually documented and a strategy against those.
And then for strategy then, so at what point, so if we're talking you get to your level 1
Yeah.
cash flow goal, then when do you move to the next level? And then when do you move to the next level?
Yeah, it's a good question, and I think it's like that question again is your decision, isn't it? Ultimately, you can continue just building cash flow assets to get more cash flow, and then any surplus cash flow you could use for profit. That's actually slower, I think, than generating just clean profit, as an example. So our cash flow assets, as an example, gave us the opportunity to move out of our jobs.
Yeah.
Right. We've then used our expertise to move up a level to our profit level.
Yeah.
So now we're doing our portfolio building service. That's our profit level, right? It pays us an income as well, but we use that for our assets. So we've now, as an example, bought a mill conversion recently using profit from our business.
Majority,
The majority, and a partner, an investment partner. So when did we decide to do that? Well, it was the right time and the right deal became available at the right time. It's not that was necessarily a deliberate decision, but we deliberately decided to build a profit-making business because we were getting to the cash flow strategy.
Yeah.
We didn't then decide, that's going to be the one that's going to be our first asset development. We didn't decide that at the time, but the deal came available and we knew we could afford it because our profit business was working.
The other thing that splitting across the levels, it sort of diversifies your portfolio in a way, doesn't it? Because if you do, because there's an argument to say if you do something well, keep doing it well to a certain extent. But if you're only ever doing, HMO conversions forever, and there's something really dramatic change in the HMO market or whatever, you're at a substantial risk there.
I had a conversation with somebody this morning, and he was saying he wanted to do 9 HMOs in this next 12 months. And I couldn't think of anything worse than doing 9 HMO developments in a year for myself personally. I mean, we do 20 to 25 for clients in a year. So, but owning 9 on my own, I just think that'd be a nightmare. I don't. It's too.
Potentially, you could do like the 4 or 5 to get to a point, like you said, and then maybe you're doing more of the other asset classes.
And you can don't forget, once you become an expert in something, once you started building your cash flow assets, you might not even need to own these things. I think it's 7 rooms I'm adding this year in terms of HMO rooms some of them are not in my company. I have a contract for those under a declaration of trust, but the other ones are funded by a third party investor that is in my company, right? So I'm now just returning to the time and expertise because I now have time and expertise, and I want to use my funds for the mill and the assets and the single lets that I'm trying to buy. I don't want to use it for my HMOs. So yes, I'm still moving forward to my cash flow assets, but I'm actually sharing that wealth with other people by giving them my time and expertise. Same as you, right? You're doing a similar thing. So we're not actually funding those projects anymore through our business.
Yeah.
They're now opportunities for people to join us on a JV basis.
Yeah.
And we're just moving up a level to use our money for the profit that we make for our assets.
Yeah.
And that again is like, it's a well balanced.
Yeah, and it's a win-win for all.
Win-win,
isn't it?
Yeah, absolutely. So again, I mean, don't get me wrong, we're a bit more down the line, but we started on our cash flow assets doing BRRR, HMO. That's where we started.
Yeah.
So, yeah.
Excellent. So just to move forward a bit as well. So I just want some general practical tips, of these strategies and how people can move forward and move forward in this space. So can you give some key practical tips for everyone?
I mean, understanding where you are is obviously the number one, but also just some practical thinking about that. So I'll use the 9 HMOs in a year example. So if you've never done a HMO development and you have some funds, let's say, and you're going to do your first HMO development, you say to yourself, I want to do 9 in a year, ultimately, good luck with that. I just don't think that's practical, So when you're setting your goals,
you got to think what 9 means. It's like the team's to deliver it.
Yeah. And
if you're doing a refurbished refinance method, there's lots of build teams, lots of project management teams, and all these other people that you have to have in place.
Well, it's the lending. Who's going to lend you that money?
Lots of lending from either bridging, development finance, and also, depending what funds you've got, lots of other investment as well.
Yeah.
And it can be very risky because even if 1 or 2 of those projects or developments don't go,
well, you're not going to achieve bridging and development finance Because if they look at you as an individual in your company and they see you've got 3-4 loans in, and you've not even delivered on one of those yet, you're not gonna.
Nah,
they're not going to leverage you. They're not going to lend to you.
Yeah.
So there's some practical things about it, which is just being realistic, and nothing should ever be arbitrary. So when you're setting your goals, okay, tell me your goal. So how much do you want to earn from property? The first thing that anybody says is 10 grand a month.
Yeah.
And I'm a bit like, well, how do you earn 10 grand a month now? Because if you do, then how long did it take you in your career to get to that position? If you don't, then why do you need to earn that from property when you don't earn that from your career? One of the first things you to do is look at your mandatory cost base for your life. And there's two ways. There's two ways to be able to sort that out. Number one is to make the money, and the other one is to cut out waste. Yeah. Right. And most people have some waste in their just renegotiating
a lot personal
of personal
expenditure. Yeah.
I reduced mine by about £800 just by going through all my direct debits, renegotiating. I'm not £100 off.
Yeah, literally, if you print out your bank statement,
go through it.
You can cross off. Yeah, go through it. Cross off the things that can be eliminated, like you just don't need them. So you've got a subscription for some magazine you don't read or whatever.
Not been to the gym in 2 months.
Gym membership, if you're not using it, cut it out. Yeah. If you are, go to the gym. Or like you said, renegotiation, whether that's utility bills, broadband, insurance, etc., etc.
Insurance. Yeah. When was the last time you renegotiated your insurance?
Yeah.
I saved £250 on my insurances, because they just go up and up and up. So those are really good things to do. It's good.
TV subscriptions, you might be paying double what you could, or could you eliminate that again? Do you need?
Well, I had Netflix and I had Sky with Netflix.
Ah, right. Yeah.
So very good. So I was paying for Netflix Premium.
Yeah.
Which I didn't even realize because they just put my rate up, and I didn't realize because I never looked at my bank.
Yeah.
I never answer their emails because they send me like 20 emails a week or whatever. So their premium service is just HD. And I'm like, well, my eyes are my eyes. I can only see what I can see. So, and then I moved it over to Sky.
So the point is
the package.
So the point is, let's say your expenditures at £6,000 a month.
Yeah.
Just by doing those things, you might bring it down to 5.
Exactly.
And that's one less HMO that you actually need.
Exactly.
Or something like that.
Absolutely. So yeah, there's those things, and then it's the mandatory. Start with your mandatory life spend if that's where you are.
Yeah.
If you and the other bit is if you're not replacing your job, and you're happy to do something over a longer term, then look at that. You don't have to start with the risky stuff. You might be able to do some profit-based stuff, and then you should be educating yourself in other things. Commercial property.
Yeah.
Educate yourself in commercial property. High yields, lower risk.
Yes.
Educate yourself in that. Single lets. We love single lets. How can you benefit from single lets? It might be, if I'm going to do a development, I might do some like freehold blocks and then do a flats or whatever. It doesn't have to be the sexy strategies of the HMOs and the service accommodations.
It's a good point actually, because the reason I really like our mill development as a project is, so at the end of it, we're going to have say 10 single lets that are quite passive, and they're in our level 3 top of the asset triangle. So that's excellent. We can keep them forever, but also we can get a really high return by doing the development and putting the work in up front. So a lot of work up front, but then it turns a passive low risk investment into a high returning because we've done the upfront work. But there are challenges that come along the way, and
we educated ourselves, right? So the path to that was we agreed the deal with the seller. We got it in an exchange of delayed completion. We did the planning. We raised the funds. We've done all the legwork, and now we're going to do the development.
And built up all the teams.
And built the team. Yeah, absolutely. So all of those things combined, you then in a position where you're doing BRRR for your asset classes, because that's our expertise. But you don't even need to do BRRR. You just find great deals. There are great deals available that you could do in those assets, and that could be, if I'm over a 5-year timeline, it could be, well, I could buy something below market value now and refinance it in a year. If it's truly below market value, so then what matters is then becoming
so because you got a good deal.
What is below market?
So let's say a basic buy to let that's worth whatever 180 in the open market, but you can get it for 150. Maybe spend a few grand to freshen it up. You've got a great deal. You're getting a higher return, but with a quite passive, solid, long-term asset.
And a potential to pull some of those funds back out.
Yeah,
you know, that hasn't gone away.
Yeah.
You know, the ability to do great deals is the skill, and it's being focused on what you want to do. So it comes back to, where am I, what am I missing, and what is my objective? It comes back to those 3 questions.
Yeah. Right. So I want 3 top tips from you based on what we've gone through on strategy now, and then.
Is that not what I just gave? All right. Okay. So, so 3 top tips. Answer the 3 questions. That's the first one. Where am I? What am I missing? What is my objective? In almost all scenarios, so that's number 1. There's tip number 2. In almost all scenarios, education's a big part.
Yep.
And then the third one is, once I've educated myself and I know what I'm going to be doing, network with the people who are doing it.
Yep.
You don't have to reinvent the wheel.
Yeah.
You know, do what other people are doing. Do it really well.
Yeah. Great.
And from you?
From me, so I would say my biggest bit of advice or top tip is, we touched on it before, but start with those cash flowing assets or a cash flow strategy first. So like I said, I did 4 buy-to-lets or whatever, which are great. I've got them now, keep them forever. But if I started with the cash flow, I could have got to a goal quicker. So start with that. You know, don't skip the gears is a way to put it. So number 2, so partnerships and, you know, working with the right people, very much like we've talked about through this episode, is that you've got experience, knowledge, education, you got time, and you got funds. Where do you sit in those 3 categories? Team up with the people that you're deficient in, and you know, and if you align with them and they're missing you, it can be a really good partnership. Also, the other teams that you've got to understand that are part of your team, so solicitors, brokers, say accountants, building contractors, project managers, all those sort of people are really important to get you to your goals. So always build relationships, always network.
Should be looking to meet those people all the time, right? You know, and get referrals and, you know, that type of stuff from people who are doing what you're going to be doing.
Yes.
You know, because again, they will be happy normally to refer these people.
Yeah. And learning, my final one is understanding the high value tasks that you can work on, or tasks that you should focus on, outsource the others or streamline them. So, you know, the classic example of that is like, you know, something like Xero as an accounting software is like, you know, that's an automated bit of technology you can use. It just does things for you in the background. And just, you know, build up those processes so you can work efficiently and focus on, say, the things of like, if you need to raise funds or you need a joint venture, focus your time and energy into that, and streamline the other things, or outsource them if you can as well as you grow.
Yeah. Well, as soon as you don't have to do something, don't do it.
Yes.
That's a good piece of advice. You know, if you're still doing your receipts in year 3, you probably made a mistake somewhere along the line.
Yeah, or work out what you consider your hourly rate is.
That's it. Yeah.
And then anything, you know, that you can outsource that's below that rate, or even for work that is like above you that you can't do. You know, outsource it to free up your time for those really important things you need to do to bring you forward in your strategy.
Yeah, that is good tips.
Yeah, and so I added a bonus one in. But
go for it. Yeah.
Just to recap, it's like I always look at cash flow goals. It's like cash flow fast or cash flow slow in a way. Yeah. And we talked about it in 2 years. If you want to get cash flow fast, you have to look at the strategies that break up the cake, like you said. HMO, service accommodation, just to simplify it. If you want cash flow slow, or you're further down the line, it's more of a pension pot, then you can look at you know, your boring buy-to-lets and commercial property and things like that potentially.
And the important part there would be to look at the profit area and retain capital as much as possible. How much can I add to that capital pot? Can I use my capital to expand my capital pot to then buy assets? And don't skip that gear, because that's the important gear, right? It's don't run out of money.
Yeah.
If that's your goal. Good stuff.
Absolutely.
All right.
Excellent. I think we've covered quite a lot there, and
it's good.
Our listeners get some good value out of that.
Hopefully, not confused everyone. Good stuff.
Until the next time.
Catch you then.
See you later. Bye bye.
Thank you once again for joining us on the Financial Freedom Podcast, sponsored by us at Property Portfolio Building. If you want to get in touch with us about today's podcast or any of the learning topics that we've gone through today, you can email us at podcast@invest-prop.co.uk or get in touch with us with whichever your social media platform of choice is. If you think you would add value to us as a guest on this podcast, you can please get in touch and let us know what you would be able to talk to us about. Other than that, we wish you well on your financial freedom journeys. And once again, thank you for joining us, and we'll see you on the next one.